All right, there we go. We are live now. Hello, everyone. Sorry for those technical difficulties. StreamYard was having some troubles and kept airing out, but now we're live. So it's good to be with you. Hopefully, you're having a great Wednesday so far. I know, we've seen a resurgence in the market. We saw that August 5th pullback in the market, but we've pretty much regained. And it's like nothing even happened from that perspective there. But it seems like, if you're looking at volumes from an investor standpoint, it seems like investors are kind of just sitting around and waiting. They're just trying to see what is the Federal Reserve going to say, because if you look at volumes, pretty much every day this week that we've seen, volumes have been quite light. And what that tells me is, I like to see, if I see big moves and it's backed up by volume, that's something I can move with from that standpoint. But if I see a big move and volume lacks, that's not all that convincing from that standpoint. So we're going to talk about the state of the market right now throughout this period of time that we'll be together. But first off, let's see who's on the call today, and let me know, where are you tuning in from? And also let me know, what stocks have you been buying? Because obviously there's been a decent amount of buying been going on. It seems like a lot of retailers have been buying from that standpoint. So let me know in the comment section. Again, this is your first time joining one of our live shows. My name is Mark Rusin. I'm a CPA here in the state of California. And these live shows are meant to be interactive. If you guys have questions, or if there's things that you're seeing, post it in the chat. People like to talk and see amongst others, what are they seeing going on in the stock market as well. So let's see who we got. We got Sean, who's tuning in from Singapore. Sean, great to have you. John Bircher tuning in from Tulsa. Good to see you, my friend. Zero DTE options. Not for me from that standpoint. Invincible. Jeff Hansen is tuning in from Minneapolis. Bought a little SPY. Nice. Can never go wrong with a little SPY there. Cindy, good to see you. Cindy, tuning in from Mizzou. What are we buying? We bought some Realty Income. So Agree Realty. How about some Vici? Some VYN, KMB. Wow, Cindy's been busy. Some PepsiCo and some Clorox. All some big time dividend paying stocks there. Mike, how are you doing? From North Carolina. Mario tuning in. Hey, Mark. Still buying SCHD, VU, and Visa each and every week. Awesome. Can't go wrong with those either. Tom from New Jersey just got back from Alaska. Wow, you went all the way across there. Did you go on a cruise or anything fun over in Alaska? Hey, Mark. Ty from Seattle. Here while I'm at work. Always love it. Bought some more AbbVie, Coca-Cola, MO, Vici, CVX, ET. Wow, that's a big buy list right there. Some solid companies. King David's in the house. What do you think if taxes are raised on dividends and unrealized capital gains? Bought some Bristol Myers. I try not to let anything sway me and really derail my investing strategy. I'm going to stick to my strategy. It's going to be the same regardless of where taxes are. I try to put as many of those dividend-paying stocks, those dividend-paying ETFs. I try to put as much SCHD that I can inside of my brokerage account, but I'm always going to look for the highest quality companies trading at the best valuations, regardless of where taxes are from that standpoint. So the tax movements that I make are really going to focus on trying to get as many, but there's only so much money that I can put within a Roth IRA, or in my case, a SEP IRA from that standpoint. So Invincible tuning in from Detroit. Carl, good to see you from Tennessee. Bought some VIG, SCHG, HDV, IWM, SCHD when it fell into the $79 range. Jamaica's in the house. Georgia, thanks for tuning in. Chris from Baltimore. Green Bay is in the house. Chi-Town is in the house. How about, what do we got here, Tom? SCHD, SCHG, FTEC, SPLG. So a lot of ETF buying there. Never go wrong with some ETFs. Florida's in the house, little SCHD as well. Canada with Vici. All right, what are we buying here? Some Amazon and Google every day. Is it just little buys here and there from that standpoint, or how does it focus on every day? Matthew, good to see you. Anthony, Miami, love it. We got Brazil in the house as well. Jeffrey, good to see you, my friend from Washington. No buys, just making some smaller option plays. I love that. So awesome. Well, it is great to be with you guys for yet another week for our live show here. And let's begin how we always do, just taking a look at the status and the state of the stock market. So let's see where we are, where we've been. So year to date, we could see that the S&P 500 right now is right around 17% on the year. And in fact, we could see that every single of the 11 S&P 500 sectors are all green by, a nice little cushion there, 5% there on consumer discretionary, which is kind of surprising when you think of Amazon and those companies there. But Amazon has pulled back. But real estate has climbed, and they're in the last spot anymore. So we went from red to green to moving up the slope here. So that's good. We're moving in the right direction as it pertains to REITs, something we've talked about a lot on this channel during our live shows. And we're starting to see a lot of that come to fruition. We talk about REITs with rate cuts coming and everything like that. I was saying, hey, let's continue to add, because these are great levels that we want to add at, and those are starting to pay some dividends for us right now. We got the energy sector down there, but on top, still really no change in what we've seen the past 18 months. Infotech, as well as communication services, the Nvidias of the world, the Microsofts, Apple's starting to wake up a little bit from that standpoint. And then you got the Metas and Alphabets, which are the largest in that communication services. Little interesting, though, to see utilities. So we have this kind of risk on a bit as it pertains to technology and communication services, but then we have a very defensive sector as it pertains to utilities. So we've started to see a bit of a broadening out. It's not just this one trick pony, or two trick pony, I should say, in terms of those two sectors kind of leading the charge. We do have three sectors that are outperforming the S&P 500, and financials isn't all that far behind either. So it's good to see, a bit of a broadening there as it pertains to the market. So again, as I mentioned at the start, is what I believe is kind of going on in the market right now is just retail buying and selling. And why do I know that? Well, I don't know that for sure, but why do I believe that? It's due to the fact that volume is so low. So if you see a stock that moves up 10%, and let's say it could be after earnings or after a big report, or maybe not after anything at all, it just moved up 10%. And an average volume for that on a daily basis, if we've looked out over the past 90 days, is say 30 million shares have exchanged hands. But you saw a 10% move, and it's only, say, 18 million shares, a little over half. That's not as convincing as if the 90-day average was, say, 30 million, and we saw 50 million shares on that 10% move. Which one are you going to be more convinced on that, hey, that has staying power? It's the one that obviously where there's a lot more volume. There's a lot more conviction in that. But when you look at the S&P 500 and the NASDAQ, and you look at the daily average compared to what the 90-day average has been on a daily basis, it has been well below from that standpoint. Didn't quite see where today shaped up, but let me show you guys where you can kind of find this type of information real quick. So let me throw my screen back up here. So you can find it on Yahoo Finance. So if you let's just go to look at the SPY. And let's see what SPY did today. For the past few weeks, or the past week or so, volume has been low. So here we are looking at the Spider S&P 500 ETF. So this is the very popular S&P 500 ETF. And right here, you can see there's average volume. So over that time span that I've been talking about here, on a daily basis, roughly 51 million shares exchange hands when it comes to SPY. You can go look at this for Apple and Microsoft, so on and so forth. Yesterday, it was in the low 30s, so low 30 million. So not much yesterday. Today, it was 40 million. Again, well off just the average number there. So although we've had 9 out of 10 days of gains in the S&P 500, the volume isn't really backing it up. So for me, it's not something I say, hey, this market is back, we are roaring higher from that standpoint. No, I have some concerns. But at the same time, it's not overall concerns, because what I think most people are doing, what I think a large majority of the big hedge funds are doing right now, is they're saying, hey, let's take a wait and see approach. There's no reason to rush into buying or selling right now, because we have the Federal Reserve that's going to be talking here on Friday. So we have our big Jackson Hole symposium that's going to come out, and you're going to have the Fed chair come out and speak. And sometimes he's not great with his words, and sometimes he gives us a little bit more information than maybe he intended to, or vice versa. So we'll see if we get a hawkish tone or a dovish tone from that standpoint. We as investors are looking for, hey, yep, interest rate cuts are in fact coming, and they are likely to come in September, something that I've been talking about on this channel now for a couple months, saying we're likely to get 2 cuts. I'm still sitting in that camp from that perspective. So that is a way that you can look at volume as an investor to back things up there. So again, Friday's going to be the big day. We get some housing data on the back end of the week. we also get the Fed chair that's going to be discussing more about the economic policy, the monetary policy, and things like that. So again, if you guys have questions, feel free to drop those into the comment section. I can't promise I'll get to all of them, obviously, because we have a good number of folks that are joining us all the time. But I'll get to, obviously, as many as I can. So before we begin, though, let me tell you about something exciting that we do have. I've been waiting to tell you guys about this. You've probably, if you are on our email list, you get updates on events that we're holding, whether it's free webinars, whether it's workshops that we do. But tomorrow, we have one of my favorites and one of our most popular, which is going to be the options workshop. So if you have been on the sidelines and maybe you've never dabbled in options before, or maybe you've been doing it for a few years and you're really looking to gain a better understanding or understand certain strategies, well, tomorrow is going to be your day, because we will be holding our options workshop where we're going to go through 6 of the strategies that I use on a regular basis. And there's a number of different ways when it comes to options trading. There's a very aggressive way. And I'm never going to come up here and claim to say, hey, I'm going to show you how to turn $5 into 5 million. That's not the approach I take when it comes to options trading. I try to be on the more conservative, the cash flow generating, how you can leverage positions that you already own, how you can potentially buy stocks at a lower price. Isn't that the name of the game? We want to buy stocks, buy low and sell high. So you can utilize options to do that. You want to buy stock at a lower price? Well, there's a couple of options you have. You can just wait and see if it drops that low, or you can sell an option contract. And I'm going to show you how I do this on a weekly basis to get to my monthly goal of $5,000 per month. Now, that's not something where it says, hey, you need to start with that goal. No, I started with a couple $100. I said, let me try and generate $250 was the first month that I ever had that I said, way back in the day, hey, that's going to be my goal when it comes to options. And then I increased it to 500. Then we went to 1,000, and we've slowly increased that over time. And let me tell you this, folks, we can go into buy and hold investing all day long. And that's always going to be our foundation of our portfolio and building generational wealth. But when you introduce options, that's what takes you to the next level as an investor. And don't think that just because you're doing options, it's something where, hey, you have to be in front of the screen all the time. You have a corporate job, a 9 to 5. I totally understand that. And that's why we talk about 6 different strategies and ways that you can do that without being in front of the computer every single day. So I hope you guys can join us tomorrow. There's going to be a link down in your description, which will give you some more information, but it's going to be tomorrow. We're going to be having it at 7 p.m. Eastern time. And even if you want to take this workshop and let's say, oh man, I would love to take that, but I'm busy tomorrow. That's okay, because by signing up, you get the recording. So hopefully you can join us live, but even if you can't, don't fret from that standpoint there. So let me share my screen with you guys really quick. So, if you clicked on that link down below, you're going to go here to where you can see a lot more information that we have. As I mentioned, it's going to be tomorrow, August 22nd. It'll be at 7 p.m. Eastern time, 4 p.m. Pacific time here. And we're going to be going through 6 different option strategies. So again, this workshop is going to be perfect for you, whether you've never invested in options before or whether you've been doing it for a few years, but you're looking to gain a better understanding. You're looking to become a more confident investor, because we're not just going to go through these strategies. We're going to look at examples, both examples that I've recently done or examples that I'm looking at right now. So all of this is going to be included within this workshop. It's a really fun one. We sell out every single time. So make sure that you claim your spot quickly from that standpoint, so that you don't miss it there. So it's kind of our back to school options investing. So just wanted to do that plug real quick and hope you guys can join us for that awesome workshop there. So let's now transition back to the Fed. So again, we have the Federal Reserve. The next meeting's about 25 days away. And that's when the highly anticipated rate cut is coming. So when we look at the futures market here, you can see that right now we're kind of 64% believe we're going to get a 25 basis point cut. But there's actually a growing number of folks that believe we are going to get a 50 basis point cut from that standpoint. And you could see how that has been growing over the past few weeks there. So, just a month ago, no one thought we were going to get even close to a 50% rate cut. But if you look down here, 1 month ago, only 3.9% were believing that. Lo and behold, today, that's at 36%, which is the highest that we have seen in from that standpoint. So not only do we believe that 100% right now in the futures market, we are getting a rate cut, It's just more determined on, is it 25 or is it going to be 50 basis? So I think, we could still get 100 basis points of cuts here in 2024. I think there could be one in September, another one in December, but we'll just see what type of speed they want to take at it from that standpoint. In the comment section, let me know, how many basis points do you believe, not number of cuts, that we'll get in 2024? Do you think it'll be 25, 50 basis points, 75, or 100? I'd be curious to see what you guys are thinking out there in terms of, or maybe it's zero. Maybe you are still holding out to believe that, hey, we're going to have no rate cuts at all until 2025. Because I know a number of you believe that when we were doing our polls, just a couple months ago, they were saying, hey, not until summer of 2025. But that's why, when that April stuff really came out, I said, hey, guys, don't let one report change everything going on. Let's see it multiple times. And lo and behold, a few months went by, we started to see the job market tank. We've started to see unemployment go from the low 3% up to the mid 4% range. We've seen the jobless number, kind of sway, whether we can believe that or not, because we'll talk about the jobless revision that they did in terms of how many jobs we thought the government was adding to the economy. That was just revised by nearly 1 million jobs, so 800 plus thousand there. So very interesting based on the information they have. So let's see what you guys think. How many basis points are we getting? Hello, how are we doing? All right, Jeff, what are we going? 25. Tom's going 75. Okay, Ingrid 25. Rich is sticking to his guns. I love it. 0. Chris with 25. Sunnyman's going with 50. King David saying, I do not understand how one can cut considering the inflation is worse than reported number for the average person. If there is if there is a cut, it's going to be 25. So I think what, King, what you may be, and I'm not going to put words in your mouth, be alluding to is probably some of these food prices. And it's kind of a fine line that the Federal Reserve has to walk, right? They can't just solely be fixated on inflation. They've brought inflation down meaningfully. And when we look at it, prices have gone up. So if you look at, what is the price of, if you want to go to food and say milk, eggs, whatever it may be over the past 2 years, exponential growth, 40+%. But now the growth from that standpoint isn't moving up as much. It's kind of starting to level set and get into that normal period that we usually see in terms of growth. So those numbers have leveled off. They haven't come down by any means, and they're not going to come down, in my opinion, from that standpoint there. So, but at the same time, they have to look at the other side of the aisle and say, hey, we can't keep this tight monetary policy, because what does that do? That could affect the economy. That could slow down the economy. If we have a lot of businesses, there's millions of small businesses that are out there, and just a slight pullback in the economy can have meaningful impact on that small business, which could lead to job loss, overall closure of the business, which is even more job loss. So they have to weigh, inflation and slowing down the economy too much to where we could tip into an overall recession from that standpoint. So that's really the threat of leaving interest rates way too high. All right, what else we got? Sean's going with 25, Eric 50, Ron 50, Jeffrey 50, 25 for Cindy. B Hall's going 0. Rob is going September 0, November 50. Frank, I don't want rate cuts. Tran's going 0. Matthew's going 50. Carl is going 50. 25. All right, so it seems like consensus is right around 50 basis points from that standpoint. It's pretty close between 25 and 50. David said 25, just enough to get past the election. That's why I think they'll skip November from that standpoint. I usually say, hey, once the Federal Reserve starts, they usually don't want to stop and do these big breaks. It's they would rather just get it over with and keep it continuous. We saw it with the rate hikes. So we'll see how the rate cuts kind of play out. But given that this is a unique year in the fact that we have a presidential election going on, which it's a close race right now, according to the polls, whatever polls that you look at from that standpoint. And, so I think they want to skip and try and stay out of that, because they're always trying to stay independent to a degree. So we'll have to see what's going in there. So we will have to we'll see what happens in the near term, but we have about 25 days. So let's go back here And let's look at our slides here. So let's look out past the September meeting to see where are we looking in terms of rate cuts. So when we look at the probabilities, here's our September meeting where we think 62% of folks are saying, yep, we are in fact going to have a rate cut of 25 basis points, which will put us at 5%, 5.25% there. And then from there, the next meeting, the majority, close to 50%, thinks we'll be down to 450. So that's interesting there because, that would put us at about a 75 basis point cut by November. And then there's a third one that's kind of baked in. 45% thinks we'll be close to 4.25. So that would mean that by the end of the year, based on this futures market, they are pricing in 100 basis points of cuts. And this is something important to look at for investors because why? Because if something doesn't work out, if this is what we're baking in, there's a lot of analysts that are baking these into their financial models. And lower rates can impact different companies that you're investing in different ways, some for the better, some for the worse. But if let's say that we're pricing in 100 and we get 150, well, that's going to sway things a lot more. Or let's say we're pricing in 100 and we only get 25 by the end of the year. Well, that's going to sway the markets one way or another, depending on the stocks and the sectors that you're investing in. So this is where things can get a little bit dicey. And if, Friday comes around and Fed Chair Jerome Powell comes out and says, hey, I think we're getting closer, but we're not that confident. Anything to, allude that, maybe there's a small chance that we don't even get a cut in September. Look out for the markets to tank from that standpoint. So that's where, you want to be able to build in a cushion there and protect your portfolio. How do you protect your portfolio? What is some ways that you can protect your portfolio at a low cost without having to sell out of your positions? Because none of us have a crystal, a magic 8-ball. You can utilize options, folks. This is where options aren't just income plays. They aren't just for growth plays. You can utilize options to hedge your portfolio and only spend, say, a couple $100 from that standpoint there. So it's a low cost outflow if you want to use hedges. And we're going to talk about that in tomorrow's workshop. So again, that link is down in the description if you want to join us for our option workshop. We do have a few seats remaining there. So if you are interested, make sure you claim that quickly there from that perspective. And again, if you can't join us live, you will get the recordings. So do not fret from that standpoint. So awesome. So let's keep cranking along here. And let's keep going with the economy. Let's keep going with the Federal Reserve. So let's take a look here at the Fed minutes, which came out today. Not sure if you read those. Most people don't. They probably just read the headlines overall, but they were generally, we could call them bullish to where, they're leaning towards us saying that, yep, we are likely to get that rate cut. So, the markets like that, we saw kind of a knee-jerk reaction where the markets went red for a short period of time, but then we jumped back up a little bit. But again, very low volume numbers overall from that standpoint. So be mindful of that. But the minutes are showing that, hey, we are getting closer, and it seems like the Fed is going to cut on in September. Now let's talk about employment. And boy, oh boy, this was an interesting one. And I've kind of talked about this every time we had our jobs report come out. At the beginning of every month, we look back at the most recent month and say, how many jobs did we add to the economy? Or the government tells us that. And I always tell people to be mindful of that number, that headline number, because if you look back, there's usually some revisions that go on, especially to, jobless claims or unemployment and things like that. And for some reason, even with all of the data that they have, the revisions are always lower. Oh, I thought we added that many jobs. Nope, actually, it was only this many. Well, lo and behold, each year the government goes back and they do some matching and pulling out folks that maybe aren't citizens, or they match them to the private payrolls to get a much more accurate report. And so this is as of March 2024. So this is even as of the most recent data. So but what this is showing us is, well, actually, we employed over 800,000 less than we originally told you that we created new jobs from that standpoint, which is a large number. In fact, it's the largest correction that we have seen since 2009. Do you guys remember what happened in 2009? We saw a market that was in a recession and falling from that standpoint. So very, very unique from that standpoint. And you could see this one just goes back to 2018. But on this sheet here, you can see the yearly U.S. job additions, or downward revisions, we should say, most of the time, except for 2022. But this one was, by a wide margin. I mean, we could pretty much add up all of these dating all the way back to 2018 and not come out with a miss as bad as we did here in 2024, which was for March of 2024, looking back a year. So a lot of it has to do with 2023 from that standpoint there. So very interesting stat to look at. So maybe the economy was starting to slow a lot sooner than a lot of us had anticipated. We've talked a lot about it of late because of the jobless claims, the rising unemployment we've seen the past 2 to 3 months. But this is showing that, well, all that job additions that we were talking about, they actually weren't as great as we were saying. And the economy was actually already starting to slow there. So not only are we getting economic news that is showing the economy starting to slow, we're also getting it from the companies. The companies, look at retailers. Again, consumers make up roughly 70% of all GDP here in the US. So if we have a weak consumer, we're likely going to fall into a recession if it gets too bad. So let's take a look at some of these key reports that I like to look at that can give you some indication. We've talked about them a couple times on our show here before. So let's start with Starbucks. And I know Starbucks popped 20% last week. We talked about the new CEO, Brian Niccol, coming in last week as well, and how much he's getting paid and all of that. But, okay, that added $20 billion in market cap. This company's still fundamentally broken right now and has major issues. So Starbucks obviously has a kind of a look at the middle and high income class, because not all of us can just go and buy $6 lattes every single day. So it's going to be more of an affluent customer base there. For some reason, people love walking around with their mermaid cups and things like that. So when we look at the latest earnings for Starbucks, well, sales declined 3% on a same store globally. What was leading that? Was it average ticket prices, or was it traffic? If I see a company like a retailer like Starbucks, McDonald's, whatever it may be, where I see consumers are pushing back and there's actually less folks coming in the store, that's a fundamental issue to me. That's saying price hikes have gone too far. I can't do the $6 latte anymore. I'll do it at home, or I'll go find another coffee shop where maybe it's only a $4 latte now instead of the $6 latte. Well, we could see that 3% decline was driven primarily by a 5% decline in the number of transactions. That right there is purely traffic, partially offset by the 2% increase in average ticket. Is that because people are buying more? No, that's because the company pushed through another set of price hikes. Overall, China continues to be an issue for the likes of Starbucks, for the likes of Nike, but that's just one company. So is this just a one-off issue to where maybe the consumer's okay? Or is there more to the story? Well, let's go look at another company. Let's go look at McDonald's. And this is going to be a very different, income class overall that you can, guesstimate here. Can't ever go wrong with a 10-piece chicken nuggets, right? So when you look at their latest earnings report, you got a Q2 non-GAAP EPS of $2.97. That missed analyst expectations. How about revenue? That missed analyst expectations. So a double miss as it pertains to McDonald's. Okay, they just missed analyst estimates. How were the numbers though? How were the figures overall in terms of transactions and things like that? Well, comp sales declined 1%. Well, that's not ideal by any means. We saw U.S. decrease by 1%, international decrease, licensed markets decrease. Everything across the board is decreasing there. So not something that's all that great to look at as an investor of McDonald's. But we've seen the company turn around. There's been some commentary that, hey, maybe this $5 meal deal, $6 meal deal. I've kind of seen different billboards. I always thought it was the $5 meal deal, but I saw a billboard the other day that said $6 meal deal, unless my eyesight was going out. But who knows? Hopefully that's not the case there for McDonald's. But that's another indication that, okay, now we've looked at Starbucks. Now we've looked at McDonald's. Two key impacts, two key look-ins at the consumer there. Okay, maybe it's just a one-off with two different companies. Okay, well, let's go look at Home Depot. Let's go see, and this could be any income class here. Any folks that are looking to make some improvements, buy new appliances and things like that. Usually if consumers are feeling good, they don't mind going out and spending on some new appliances to keep up to date from that standpoint. But when you look at here, okay, they beat analyst estimates, but analyst estimates were actually quite low from that standpoint. Let's look at the actual figures here. Well, comp sales of the second quarter decreased 3.3%. This is a company that hadn't seen comp sale decreases for years. And now it's like a regular thing every single quarter for Home Depot. Comp sales just in the US, even worse, down 3.6%. Okay, what about guidance? And this is where management, because again, they're issuing earnings that are looking back as of the end of June. They issued this on August 13th. So they've pretty much already seen a month and a half of new data before they have to worry about giving guidance. So that's going to be baked in. Hey, guys, we're off to a rough start here. We're going to have to bring down guidance. Or, hey, we're off to a great start. We can reaffirm guidance. Or we're off to a fantastic start. Let's boost it from that standpoint. So they already have another month and a half of data compared to what they already issued. Well, what is the management team seeing? They updated their fiscal 2024 guidance, which says total sales to increase between 2.5% to 3.5% from that standpoint. So, okay, they're also adding more stores. So I want to focus when we're looking at retail on comparable same store sales. What do they think is going to happen? Well, they're declining by 3 to 4%. We just saw 3.3%. So we think it's actually going to get a little bit worse before it gets better. So we had comp sales decline between 3 and 4% moving forward here. That's not great overall. So, okay, now we've looked at three companies that are showing us that, okay, the consumer has some issues. And we're looking at three entirely different companies. High-end coffee joint, McDonald's Happy Meal, $5 Happy Meals, home improvement company, the largest home improvement retailer from that standpoint. Okay, well, let's try one more. How about Walmart? And Walmart issued earnings last week, August 15th. Press release came out. They beat on both the top and bottom line. And I would say that the Walmart expectations weren't all that low. In fact, they were probably pretty high. Global e-commerce sales, so even more online sales with their Walmart Plus or whatever they call it, grew 21%. And they're fulfilling them at the stores from that standpoint with their marketplace there. How about the issue their guidance for the next quarter? This is just looking ahead one quarter. What'd they do? They raised it. They have seen another 15 or not 15, 45 days of data roughly. And it says, hey, we like what we're seeing. Let's increase the guidance there. So that's exactly what they did. Net sales are expected to grow 3.5 or 3.25 to 4.25 there. Versus estimated analysts were looking for 3.88. So Home Depot struggling, Starbucks struggling, McDonald's struggling, Walmart seems to do well. They are firing on all cylinders right now. But what does that tell you from an investor standpoint? What does that tell you about the status of the consumer? Are we seeing some of those other folks that maybe don't regularly shop at Walmart starting to trade down? We saw it with Target. Target was up, 11, 12% today. Same type of situation there. They've been starting to get things rolling again. So folks have to buy groceries and things like that. So Walmart's the largest grocer overall. Target, not as much on the grocery side of things, although they're trying to, implement that a little bit more. But we're starting to see consumers trade down. So just because Walmart and Target issued solid earnings, that could also be adding to our thesis that, hey, the U.S. consumer may not be doing as well. A lot more folks are saying, hey, I know I usually shop here, but I'm going to go and check out Walmart and see if I could save a little bit more because wallet's starting to get a little bit tighter. People are worried about, losing their jobs. I think I saw a stat today that said we are at the highest percentage of folks right now that are employed that are concerned about getting laid off. It is a 10-year high. And I don't think I had that article up at all, or else I would have showed it to you. But I think it was on Yahoo Finance. So that was something interesting to look at from that standpoint there. So a lot to be concerned about overall. This isn't just, we're flying higher here. So, And that goes back to this whole option thing. And that's why I love it so much. I always want to try and help and teach you guys as much as I can as it pertains to portfolio management and looking for stocks and ETFs and things like that. But options it's gonna take you to the next level, folks. And I'm telling you right here, it's not as complex as people make it out to be. You can make it very complex. Let me tell you that. You can make it very complex. But the strategies that I use on a regular basis, once you go through this options workshop, you're going to be like, holy smokes, I thought this was going to be extremely difficult. And I thought this is something I had to be glued to my computer every single day. I work a corporate job. I can't do that. No, you don't have to do that, folks. There's different strategies that you can apply. And the great thing about options is the fact that there's a strategy for whatever market we are in. If the stocks are flying higher, there's an option strategy for that. If we're concerned about downside, there's a hedge against that. If we're in a free fall, there's a way to make money on that. There's always an option play, and that's why I love it from that standpoint there. So let me go over to the comments because I know I've been chatting a bunch here, showing you guys some slides overall and see what we got going. Anid, you're late. Oh, no worries. No worries at all. Glad you could make it there. All right, making sure buying some CVX. All right, what are we watching offhand? VGT, not VU, SCHG as well. James tuning in from Dallas, Texas. Awesome. I'll be there in a few months. SPLG, SCHG, SCH. Wow, we're buying all the Schwab ETFs there. Looking into Canadian companies as well, ENB and CNQ. SCHD is a no-brainer. I've been talking about that one for quite some time. People didn't believe me for not you guys, but plenty of folks on the in the comment section on YouTube. But we're just trying to help as many as I can, and they don't all have to agree, and that's what makes a market there. All right, what else we got here? I want to make sure I'm not missing anything. Tom's got some VGT, but stopped and loaded up on FTEC. All right, what do we got? Walmart has more shoppers in a down economy. Yep, Walmart is one of those more defensive plays. That's why you could also see the likes of Costco even increase during those times. That's a company that I believe is, extremely elevated. It's a company that I love. But you have to be able to separate a company from a stock price, and that is a valuation I do not love at all. I understand it's defensive, but valuation has to play a role when it comes to investing in stocks. But Costco and Walmart are two companies that can help tread water if, in fact, we ever did fall into a recession. There, we got Greece in the house. There, John tuning in from Minnesota. Thoughts on Spotify? Spotify is an app I use frequently, a stock I do not invest in. I know, I was curious from an investor standpoint. I liked it as a user of the platform on them not raising my my monthly fee for, a number of years until more recently. But, that was always a question mark on the investor side is, they have a unique fit here. Why aren't they increasing? And I know it's from competition because folks will say, well, I'll just leave Spotify and go over to Apple. So I see both sides, but I think there's some efficiency improvements Spotify can have, but they have a great platform overall from that standpoint. So is Walgreens a good? That's probably not one. Yeah, Tom's going to say no Walgreens for me. Yeah, that's not one that I'm willing to play with at all. Run away is what Tom says there. Thoughts on Upwork as a stock? This is that one that what was his name, Mark McVeigh or whatever, who went on CNBC and said, I think he was talking about Upwork, and then the guy asked, well, what do they do? And he said, well, what they wait, I think I'm losing you. And then all of a sudden, he couldn't hear. So Upwork isn't one that I've been interested in investing in. I've used their services once or twice in the past, but again, I think there's just a lot of ways to get around it. I don't know, long term, is it something that can stay up? But, again, I don't follow it all that closely to have an idea on the financials right now. So probably not one I'm going to put an opinion on at all. SCHD versus JEPI, SCHD all day for me. JEPI is going to be a great spot to put money in short term. That's kind of my goal is I'll put, if I have some money sitting on the side, I'll put it in JEPQ for some short term, just for a place to hide for a little bit, but not something that is a long-term play that I'm just going to say, hey, I'm going to park, 10 grand in here and just let it roll for the next 10 years. It's just, there's a piece of it that's going to be, the upside is going to be capped. And because they utilize options to really juice their overall premiums, If you have a market that continues to climb, those options are going to be less profitable, or on the opposite side of that. And then hence the premium can come down. But if a market is falling, that's when JEPI or JEPQ could be a great spot to hide, because those option contracts that are utilizing are going to be extremely profitable from that standpoint there. So maybe a little off topic, but could you explain why AMT has dropped 10% while we are on the verge of rate cuts, which I thought would make the dividend more attractive? So I haven't looked at AMT today, but or are you referring to a 10% pullback overall? You're talking about a 10% pullback from a peak here. So it could be some profit taking, because if we look here, this is a stock that, at the start of May was trading at 175 by the end of July. So what is that? 3 months or so, we're at 234. So that's a very big run up there overall. And that was kind of what we were talking about since that April, May time period. Hey guys, let's add to REITs because rate cuts are coming. So again, the market has fallen off a lot, and that's at August 5th. So that's the majority of it, where we went from 235 down to the mid 220s there. So that was just a broad sell-off with all the stuff that was happening over in Japan. So you can't fault the company there for that. But since then, it's kind of just been trading sideways. So the majority of it has to do with probably some profit taking and a combination of August 5th. Don't think there's anything drastically wrong with AMT by any means. And again, it has come up a great deal. So right now, trading at a price to FFO around 20, that's going to be, still, a discount compared to its 5-year history. Is it growing as fast as it did? No, not right now. So does it warrant a little bit lower of an FFO? And again, so it's probably just profit taking in August 5th from that standpoint. I don't think there's anything fundamentally wrong with the business, if that's what you're asking. Definitely something that you could stay long on if you do have it. Any thoughts on Southern? So when it comes to utilities, I go XLU. That's the way I get exposure to XLU overall. So, those are things that, if I don't cover a particular sector all that closely, I'll go ETF route. So energy and utilities are two that I'll cover a few of them. So I got, NEE, I got COP. I've invested in Exxon and Chevron in the past. Don't own any of those big two right now. But what I do own is things like XLE. I have owned XLU in the past. I'm out of that right now. IEO, I've owned that one in the past. That's strictly oil and gas. So that's one I'm going to be, in and out of as we get closer to the election, because if one candidate wins, IEO can jump astronomically, or a good portion. And if another candidate wins, IEO could see a bit of a pullback there. So it's kind of mix and match on what's going on overall from that standpoint. So very interesting there. Is MMM a buy? So if you guys are part of our newsletter and you are Edge Plus members, you will know that I jumped into 3M. About 2 weeks later, I got that 20% plus bump, and I was out of it from that standpoint. So when I get, a stock that I expect to be, hey, I expect this company to have some reasonable returns, I'm going to get a very solid dividend, but it pops up like that 20%. All of a sudden, valuations are jump up 20% as well. Doesn't look as intriguing. Let's get out of it. That stock already did more than I had planned for it. So anytime I'm entering into a position, I have a thesis and a strategy of what do I expect from this particular stock here. And I'm always reevaluating. So whether you want to be very hands-on, you can be more hands-on where you're reevaluating on a weekly or monthly or quarterly basis, or you can be more of a hands-off. There's no right or wrong answer. There's no one that's going to be a lot more, do better from that standpoint. It's just what works for you guys there. So continue to look for it. Continue to find ways to see what works for you, what fits for you from that standpoint. What risk profile are you willing to take? And that's why I always tell people I work with on my one-on-one coaching program, where I say, hey, just because someone else told you it's a buy, they have an entirely different strategy than you. You have no idea what their risk profile is. You have no idea what their overall goal is. Is it dividend? Is it growth? It may not match your overall. And the first step of my investing process is always to see, does this particular stock that I'm looking at, does it fit my strategy? If it's for me personally, I like to lean towards dividends. Doesn't mean I turn a blind eye to growth. But at the same time, if I'm looking and I say, hey, this is a non-dividend stock, okay, well, that's going to be a strike there. If I'm looking more to add some more dividends here, I'm going to lean more towards, risk averse. If that particular stock is a highly speculative stock, highly volatile stock, oh, that's another couple strikes there. Probably not a good fit for me overall from that piece of the portfolio. So interesting things to look at overall from that standpoint. So next week, so after Friday, we have to get through Friday. We have housing data coming up this week. We have the Friday with Jerome Powell coming up this week. So still a lot to happen. But what is something that can alter this market entirely? That is going to be Nvidia's earnings. So we have Nvidia's earnings that are coming up next week. So we're going to have to keep an eye on that. And I want to share a video that I saw on CNBC. So let me see if I can get this set up for you guys really quick. And it's going to be, a take from an analyst perspective, similar to what I'm talking about right now, saying, hey, this can alter the market one way or another, depending on what you believe Nvidia is going to do. I personally, just kind of give it up front, I personally believe Nvidia is going to have another blowout set of earnings. And why do I believe that? Well, I kind of talked about it in my latest video. If you saw that, we have seen the Mag 7 companies already report earnings. And what was the one thing every single one of them have had in common? Not just this past quarter, but the past few quarters, plural, more CapEx spending, more AI spending. Where is the majority? I would be safe to say that 70+% of those CapEx dollars are going towards artificial intelligence. Where do most artificial intelligence dollars go right now for many of these companies? They're going towards chips. What is the most powerful AI chip in the world right now? That's Nvidia. So we've already kind of gotten a foresight into what those Nvidia earnings are going to be. They're going to be quite solid. Demand is still there. We just saw that Google is telling us, hey, the risk to us is under investing. So they continued to bump up their AI spending. We saw that from Meta a few quarters ago. Apple's starting to get rolling with the AI spending. Microsoft obviously has been at the forefront of AI and still continuing to spend. All of these companies, Tesla wants to be, priced as an AI company. So we're going to see, what Nvidia kind of has in store from that perspective here. So let's take a look and hopefully, let me know if you guys can hear this here because we haven't done kind of the video take before. So I'm going to drop this in and let me know that you guys can hear it.
Joins me now. Welcome back. It's good to see you.
You too.
Well, you don't feel like being out of Amazon that long, I guess, right? That's the one you sold, and now you got your eye on it again. Why?
My favorite three, Scott, in the Mag 7 right now are Apple going into the iPhone upgrade cycle this fall. Then Meta, because they're at all-time highs. They're really the first poster child of somebody who's making money hand over fist from AI. And then
big ones right now
Nvidia,
the
Godfather
are Apple. He mentioned Meta, Nvidia are his kind of big three. Those are his top three that this particular analyst likes. And then that fourth one has actually been my favorite stock and my kind of top pick moving forward. A big tech type company, even though it's consumer discretionary overall, on a company that can work in a recession and can continue to work if the economy continues to progress and get back to its growth mode. So he's talking about Amazon here, but in a second, he's going to get back into talking about.
But after that, it's Amazon, and I did sell out of it in July, but it's darn cheap on a 5-year basis. It's like trading at all-time lows on a forward PE basis.
So he was talking about on a forward PE basis. But many of you that have come through the coaching program or you're in our Edge Plus, we've talked about Amazon on an enterprise value to EBITDA standard. And in fact, it is trading at levels that were last seen in 2022 when the whole market crashed more than 20%. Amazon has come a very long way since just 2022 when the whole market tanked. But if you take out 2022, this is the cheapest that you've been able to buy Amazon based on this single metric in the past decade plus. And I've talked about this on other videos as well. So not just the PE multiple that he's talking about. Again, I don't like to pay attention much to PE multiples when we're talking a lot more about these higher flying, high growth stocks per se. But for Amazon, it's okay overall.
Nothing really was wrong with the quarter that they just reported a couple of weeks ago. So I think they are definitely one that's on my radar, and I plan on adding probably in a few weeks as we start to get closer to the next tech earnings season.
Jump on board, Eric
Well, we
Jackson.
can't get to the next tech earnings season before we get out of this one, and we still have to consider Nvidia a week from today.
So here he's
How
going
do
to
you
start
see
talking
that?
about Nvidia.
I mean, it's huge, obviously. It's the most important stock in the world right now. So, you know, if they laid an egg, it would be a major problem for the whole market. I don't think they will. I think they're going to surprise to the upside. If you look ahead at sort of what Wall Street is counting on a go-forward basis, it's almost like this explosion of AI revenue that they've seen over the last year and a half, you know, is going to just sort of dry up. And I just don't think that's the case. Eric Schmidt gave a talk at.
So those were some of the that's kind of what we've been or what I was alluding to here is you know, it's going to be a make or break overall as it pertains to Nvidia. It's one of the top 3 largest companies there. So the weighting is huge. And if Nvidia all of a sudden is slowing down, that's going to give major concern to all of the other companies. There could be a trickle down effect that says, hey, if Nvidia is slowing down, they've been the golden child, the poster child for all of this growth that we've seen the past 18 months. Because that's really, you know, these Mag 7 companies, and I've talked about it in videos, have carried a significant load. If you just pull them out of the equation and say, okay, how healthy is this market? How many of these S&P 500, the other 493, are actually growing? Stock market's up something like 7-8%. It's not all that much when you pull those out of the equation there. Now, of course, they're part of the equation, so we're up our 17%. But the other unique thing, and I was looking at this with a student the other day, is a lot of people are like, man, we've had some huge gains. 2023 market up over 20%. 2024 we're up almost 20% again. It's like, you know, this is massive gains here. I feel like, you know, I have to take some off, and that's not unreasonable to think that we've had a huge run in the stock market. But if you go all the way back to the start of 2022, the S&P 500 is only up in a matter of, what is that, over 2.5 years, almost 3 years now, only up roughly 18% in a 2.5+ year time period. So when you look at it from that lens, you might say, okay, well, maybe some of these gains aren't actually all that crazy. We have just rebounded from the massive loss that we had, even with these big gains. You know, I always say it that, hey, just a 20% loss, it doesn't take a 20% gain just to get back to even. It takes more to get back to even from that standpoint there. So very interesting overall from that standpoint. So we're going to have to see what Nvidia does for us overall. But there's one more video that we want to look at here, and this pertains to Tom Lee, and this pertains to small caps. So we've talked about REITs. We've kind of, you know, hit the nail on the head. We've beaten that dead horse as it pertains to REITs. If you're not in REITs now, I don't know what you've been waiting for, because rate cuts are on the horizon. That's going to be a sector that's going to benefit, and it usually doesn't wait for the rate cuts to happen. It's just the talk that, hey, they are coming. Let's jump in early. Because again, when it comes to investing in the stock market, it's forward looking, less about what you did for me, more about what you're going to do for me overall. So it's key to be ahead and looking ahead as you manage your own portfolio there. So Dividendology in the house. Good to see you, my friend there. So let's take a look here at Tom Lee, and he is going to be discussing small caps. That's another area of the market that can benefit greatly as rates come down. Why is that? Well, these are companies that could have to rely on debt a lot more, and lower interest rates are certainly going to help a sector that has to rely on debt a lot more there. So let's take a look here and see what they're alluding to as it pertains to Tom Lee, who has strictly been the man overall. So let me share that screen with you guys right now. Right there. There you go.
Back to the broader markets, the S&P 500 up 8% since that 3% drop on August 5th. Joining me now is Fundstrat co-founder, managing partner,
there he is,
Tom Lee.
The man,
Tom,
the myth, the legend.
Good to have you back. Now, I know you're saying that the bottom is in for the market from that early August move. I'm still fixated on your expectations for small caps. I've been talking about them a bit in this hour through the rest of the year. You still think that they could go up 40% by year end?
40%.
Yes. John, you know, for small caps to rise 40%, means that the PE, the median Russell 2000 stock, goes from 10 times to 14 times. So it's not asking the market to provide some magic and a huge revaluation. It's actually just saying small cap stocks, which have been left for dead largely because the Fed's been tight for almost 2 years, as they start to normalize policy and as mergers pick up, its merger activity has been accelerating this year, and it should really strengthen because it's a sign of CEO confidence. All of these flow through to benefit small cap stocks, and it's not like smaller companies are growing slower. I know people post all these stats about small caps losing money. It's mainly because of the biotech components basically don't make money, and that's the largest cohort of stocks in the Russell. But the Russell 2000, John, we've already seen magic.
They don't make their money. What he's alluding to is there's a bunch of R&D at the head at the beginning of a lot of this biotech stuff. Not until they hit on one of these big time drugs can they start to see the profits come in to fruition there. So you kind of heard it at the beginning talking about 40% upside overall, which is just amazing there. So when you look at IWM, we saw, in the last month or so, a big uptick, a big spike in IWM. And then lo and behold, August 5th came and we're right back down where they lost, a good portion there. So in the past month, the iShares Russell 2000 has gone nowhere. It's sitting at minus 0.2% or something like that. So, we've kind of fallen back and give up a lot of those gains that were made in the past month. And then over, a course of the past, the year to date, small caps are up just 7%. So they're drastically still lagging the greater S&P 500. And he talked about the multiple being at 10. He believes, we can get up to 14. It's historically actually closer to the higher teens. So that just shows you that's kind of, the upside potential on where they're at. And that video was from yesterday. So again, small caps were up 1% today. So I guess you still have another 39% or so that you could incorporate here. But let me know in the comments section, are you utilizing small caps? Are you looking for small caps to outperform for the rest of the year? And the thing to be careful is that, let's say that you're not in small caps right now, and things can obviously get volatile overall as it pertains to Jackson Hole speech coming up here on Friday. But once we get past that, at the same time, we're going to be entering into September. And September historically is the worst month for the stock market. So make sure you keep that in mind overall. And that's why I always tell people, especially students that I work with in my one-on-one course, is always have cash available because we never know when opportunities persist. Always do your due diligence on stocks ahead of time. Find areas and if a stock's trading here today, say, okay, well, what if it went down to this level? Where would all of the valuations be at that point? If they look a lot more intriguing at that point, that's probably need to be your buy price. And you need to build a watch list for yourself. Folks that are part of the Edge Plus program get our top 10 stocks that we're watching, stocks that we're not necessarily buying today, but we're hoping to buy if we do, in fact, get a pullback. And again, I told you at the start is, we don't necessarily have to wait around for a pullback, right? There's two ways to buy stocks, potentially buy stocks at a lower price. How is that? You can just wait around, or you can utilize options. And that gets us back, before we head out here, is talking about our options workshop that's going to be taking place tomorrow. So if you are brand new to options, if you've been trading options for just a few months or so, or a few years for that matter, I'm going to go through all of the 6 strategies, 6 of them that we're going to go through. Buying calls, buying puts, selling covered calls, selling cash secured puts. We're going to be doing all different types of spreads as well. Not only first explaining what are these option strategies, when should I use them, what are pros and cons of each, what are the risks, is this a higher risk trade or a lower risk trade, what's a good trade if I want to have a hedge, what's a good trade if I want to be a more aggressive at a certain point in time, maybe around earnings or things like that. These are all the things that we'll be touching on. Again, you do not have to join live. You get the recording whether you can join live or not. So you will have access to that. So, check out the link down in the description below. I've already seen a few more folks come in there. So we do have a couple of spots left over. So if you are on the fence, make sure you get in there and grab that spot there so that you have that full access moving forward as it pertains to our options workshop tomorrow. Again, it'll be at 7 p.m. Eastern time, 4 p.m. Pacific for those of you that are able to join live. And again, I hope to see many of you there tomorrow for that. So, all right, questions here. What do we got going? Cindy said, keeping my fingers crossed for him to be correct since I increased small cap exposure in my 401k. Well, if there's one person that continues to be corrected, it has been Tom Lee. Leo's got a question. Do you let people know your trades in your paid newsletter? Yes. As you become a member of our paid newsletter, you not only get insight into multiple of our portfolios. It's not just my portfolio, and you can see all of my buys and sells, but you get access to our Discord where you get to see our real-time trade alerts there, Leo. Paul's said, I bought 10 shares of Nvidia, average price $108, holding until 180. Leo said, are you keeping IWM or selling? So I've been in and out of IWM. Don't hold any right now, but looking to, in fact, get back in. I'm just waiting to see how this Friday. So I'm probably going to set up more of an option trade. And that's actually going to be one of the examples I'll be discussing on a forward-looking basis in tomorrow's options workshop to kind of show you what I'm looking to do there as it pertains to IWM. Do you offer an advanced option class? So you could definitely email me, Jeff, as it pertains to what you're looking for. So in the past, we've done some one-off option courses. So it would be more one-on-one. It wouldn't be a workshop, a group coaching program overall from that standpoint. But you can contact me and we can go through what I do in the 201 one-on-one courses that we've done in the past there. Monty says, small caps are my second largest position, which I recently took up. UK based, so I don't get IWM, but similar ETF still. And yeah, there's a number of them. It's not just IWM out there. There's a number of different ones that you can do there. The old McDonald's ag business there. Not all that familiar with that one at all. I'm just glad to be here. Awesome. Well, great to have you. Kev, to be honest with you, I don't do a ton as it pertains to bonds, just seeing where, I'm at. Still longer term investor, not really looking for much in terms of the fixed income side of things. But I will be honest with you, I have invested in small pieces of TLT, and it's more of a timing thing. So if you're looking not just to get, locked up in a bond, but you want more of the ETF exposure, kind of what you're talking about here, to be able to get in and out of, TLT is one that I've used in the past, and it's obviously a popular one there. As well. Never been interested in retail, but after watching your video about cheap 52% discount stock, I picked up 2 shares of Lulu since it is so low, as well as Ulta. And yeah, we saw the big guy Warren Buffett buying himself some Ulta Beauty shares there. So awesome. Well, that is a wrap. We are at an hour right here. And just to kind of give you guys a heads up in terms of the live shows moving forward, because I've had a lot of people ask me, hey, Mark, can you do these more frequently? So what we're thinking about doing moving forward potentially is continuing on with the live shows, but maybe not making them an hour long, maybe just kind of fixating and focusing on a few option things, taking a look at the top 3 stories in the market and doing them more frequently. So if that's something that you guys would be interested in me doing rather than just one longer power hour type, and you'd rather have a few shorter ones so there's more economic and market updates throughout the week, definitely let me know in the comment section. I always trying to read every comment as possible, given my time restraints there. So if that's something you'd be interested, let me know there as well. So it's always been a joy to be with you guys. Thank you guys for all the support that you've shown me. And again, make sure you sign up for our options workshop tomorrow. It'll be taking place at 7 p.m. Again, you could have done options for a number of years or brand new. We're going to be breaking it all down for you to show you how you can start adding income to your portfolio. Whether you're in front of the computer on a regular basis or whether you work a corporate job, we're going to be talking about different strategies that you can utilize that will work for you. So again, I hope to see you guys there. That link's going to be down in the description. And please hit that like button down below to show your appreciation and spread our channel out to the masses here on YouTube. Thanks again for tuning in with me, and we'll see you next week. Take care. Bye-bye.